Apple, ticker AAPL, is currently trading at $162.92 and is up almost 300% over the last 5 years. Now, Apple is one of the largest producers of phones and other personal technology products, and I strongly believe that over the next many years, Apple will stay on a steady rise. With this said, in this video, we will calculate the current intrinsic value of Apple, and to do this, we'll jump over to my interactive stock screener, where we'll plug in the ticker for Apple, AAPL, and wait for all the important metrics to show up. Now, to further evaluate this stock, we'll have a look at the 9-pillar analysis and calculate its intrinsic value using the Graham's formula revised, discounted cash flow model, multiples valuation model, and the dividend discount model. All these valuation models will lead to our ultimate valuation at the end of the video. Now, if we jump back to our stock screener, we can see that Apple is currently paying out a dividend of about $0.92 per share per year, which gives us a payout ratio of just about 15%. Now, a low payout ratio is very important for any company which must direct a large proportion of its cash flow towards research and new products such as Apple, and therefore it is great that Apple has such a low payout ratio. Now, if we look down here, we can see that the analysts currently project a price of $170.62 by the end of 2023, which is about $10 higher than the current trading price. We can see that the institutional ownership of Apple is sitting just at about 60%, and the beta is at 1.3, which shows that the volatility of Apple is slightly larger than the overall market. Up here we can see that income and cash flow have both been increasing over the past year, which is great. Now we can jump to our 9-pillar analysis, where we will plug in the ticker for Apple. And right away we can see that Apple is doing pretty well. We can see that the 5-year profit margin is certainly above 10%, staying at about 40%. We can also see that Apple has been increasing its income and revenue by 18 and 12% year over year over the past 5 years. Now, there has also been a large decrease in the shares outstanding, and this means that each of your share now accounts for a larger percentage of the overall company, which is great. The long-term liabilities of the 5-year free cash flow is also very low, which means that Apple has no issues paying down for all its debt. The free cash flow is also increasing very well, and there has been consecutive dividend growth over the past 8 or so years at a very decent rate. Now, the only thing that I do not like about Apple is the 5-year PE ratio and the price to free cash flow. But if we scroll down to the financials, we can see that in the year 2014 to the year 2019, the PE ratio has been below 22.5, and only in the year 2020, 2021, and 2022, this PE ratio has increased, and therefore I do believe that in 2 to 3 years, the PE ratio will come back down to a lower value. Now let's jump to calculating the intrinsic value first using the Graham's formula revised. We'll plug in the ticker symbol for Apple and wait for the metrics to show up. Now, to calculate the intrinsic value, we'll use the formula up here. We'll plug in the earnings per share and multiply that by the average yield on AA Corporation bonds, which will then multiply by the sum of the base PE and the multiple of the 5-year growth estimate and the growth rate multiplier. This will give us an intrinsic value of $102.95, currently 50% lower, 57% lower than the current trading price. But let's jump to our next valuation model, which is the discounted cash flow model. Here we plug in the free cash flow over the past 10 years and calculate the average growth rate to be at about 13%. And as I do believe that Apple is a very strong company with great potential, I predict a 6% growth rate over the next few years. We use this growth rate to predict the future free cash flow over the next 10 years. And then we calculate the discount rate using the WACC and the 9-pillar analysis. And as we can see, the discount rate is very close to the actual WACC of the company. We use the discount rate to calculate the present value of the future free cash flow, which we then sum up, add any cash and cash equivalents, subtract total debt, and get an equity value of about $2.5 million. We divide it by the shares outstanding and get an intrinsic value of $163, which is mostly spot on with the current price of the stock. Now let's jump to our next valuation model, which is the multiples valuation model. Here I will be comparing Apple to Microsoft, Google, and HPE. I will take these companies' current stock prices and divide by their current earnings per share to get their PE ratio, or the price to earnings multiple. I will then average out this PE ratio and multiply by the earnings per share of Apple to get an intrinsic value of $155.25, again slightly lower than the current trading price. Now let's jump to our final valuation model, which is the dividend discount valuation model. Here we can see the yearly dividend payout over the last 5 years and the increase in dividend over the last 5 years. The average growth rate is calculated to be 6.59%. I do believe that in the future this growth rate will be slightly higher at 7.20%. Now to calculate the intrinsic value, we take the next year's dividend and divide by the WACC negative the projected growth rate, which gives us an intrinsic value of $125.51. Now we can jump to finding the ultimate value of Apple. We'll plug in the ticker and we will average out the grams formula, multiples valuation, discounting cash flow valuation, and the dividend discount model valuation to get an intrinsic value of $136.78, which is currently 15% lower than the current trading price. Now, as a value investor, I always like to plug in a margin of safety, and as in my eyes, Apple is certainly a company that should be trading at a premium. I will plug in a margin of safety of only 5%, which will give us an acceptable buy price at $129.94. If we have a look back at the stock screener and plug in 365 days, we can see that over the last year, Apple has certainly been trading at that value at a few occasions actually. And therefore, as I do believe that stock prices will keep decreasing over the next few months, I would wait for Apple to hit the acceptable buy price we have calculated, and personally, that is when I will buy Apple. With that, thank you very much for watching. Make sure to like the video, make sure to subscribe if you want to see more analysis like this, and let me know down in the comments which stock you would like me to evaluate next.